Hello, I'm Angeline and welcome to Beat the Street, the show that gives you all the tradable news and data you need ahead of the Wall Street Open. Coming up, the Fed in focus. The U.S. Central Bank expected to keep rates steady, and Jerome's Powell and the dot plot is being eyed. Also, options expiration. Some $5 trillion in U.S. stock options are set to expire this Friday. We'll have a quick check with Chris Vecchio, all the way from New York, to find out what that means for volatility. And the valuation for SpaceX has apparently jumped closer to $180 billion in its tender offer. That's according to Bloomberg News. Now, good afternoon. I'm Angeline and welcome to this new edition of Beat the Street. Not long now before Wall Street starts trading. We're just getting those data points just coming out now. We've got the PPI number, excluding food and energy. Year on year, we're getting 2% rather. We were expecting 2.2%. We got a slightly cooler figure, 2%. And on the month-on-month reading for November, we were looking out for 0.2%, and we got zero change, no change, 0% actually was the reading. So all this really interesting, because what this means is, like the previous month, the indication is that inflation is cooling and the Fed is probably done with tightening. The PPI, in terms of the final demand figure, tracks the prices that U.S. businesses get for their goods and services. Let's just have a look at to see how that did as well. The final demand year on year, we were looking at for 1%, and we actually got 0.9%. The month-on-month figure also slightly lower than expected. So the suggestion there is that inflation is still cooling. Just checking in on the US dollar basket there, not much of a move because it was pretty much bang in line with expectations. Also checking in on the Wall Street for you. Similar picture there, still early in the session. We haven't got to the cash session yet. The other big thing this week, of course, is the expirations. These are the options expirations that are due, I believe, on Friday, said to be the largest on record. Some $5 trillion, in fact, in US stock options set to expire this coming Friday. Well, to talk about the Fed, of course, which is a big story for this session and those expirations, I'm joined now by Chris Vecchio, all the way from New York. Chris, thank you so much for joining us on this very busy day. Let's start with the Fed first. No change expected, but what do you expect Powell to say?
There's going to be a shift in the summary of economic projections. It's one of the 4 meetings of the year in which the Fed produces a new set of forecasts that they dole out to market participants to give a kind of a guidepost or a roadmap for how they'll proceed moving forward. So we'll get those new dot plots, as everyone likes to call them, the Rorschach test, to see how we think the Fed thinks about which way the economy will evolve. But the fact of the matter is that inflation's coming down a little bit quicker than they had anticipated per their forecasts. We see that the labor market is holding up a little bit stronger and growth has been a little bit better. So while we already look or conceiving of a situation where the Fed may be done raising rates, we also need to be cognizant of the fact that the market is pricing in 5 cuts for 2024. And I don't think the Fed is going to deliver 5 cuts in their dot plot. The economic data just doesn't warrant that right now. And so there could be a little bit of an issue here, a little bit of a dissonance between market pricing and what the Fed believes will happen. And that would be a point for volatility, particularly in the yield space. Obviously, if it's impacting treasury yields, which may ultimately see a little bit of a kick higher, that could be something that helps the US dollar against the yen, against the euro, and the British pound, of course, which is reeling after the GDP report today. Otherwise, Powell himself is probably going to take a very balanced tone. I imagine that the bulk of the press conference, he is going to be asked about the timing of those Fed rate cuts. And given how quickly yields have come down since the November 1st meeting, it wouldn't be surprised if he pushes back against the idea that the Federal Reserve is immediately looking to cut rates in 2024. In terms of practicality, Angeline, we do have an election next year here in the United States. The Federal Reserve rarely, if ever, cuts rates within 2 months of a presidential election. The last time Really, that happened under non-economic circumstances, for reasons outside of the regular ebb and flow of the economy. You go back to 2008, when the U.S. economy is in a dire situation with the global financial crisis reeling and beginning to gather steam here. So would the Fed just do this for the sake of doing it? No. I think the fact that you look at the calendar for next year, March, May, June, July, that's really the only time the Fed has to cut rates. Otherwise, they go into a period where they're blacked out. So a little bit of pushback today, I think, is coming from the Fed chair.
I have a gut feeling that you might be right. And also these PPI numbers. I'm just looking at the chart here. We did see now actually a slight spike on Wall Street. This mirrors the Dow Jones Industrials, but it has come back off again. Do these PPI numbers kind of indicate that the because the inflation is kind of cooling, that all this talk is actually essentially doing the Fed's work for it?
Yes, the producer price index isn't that highly of an esteemed data release for the Federal Reserve. They care more about the PCE and the CPI numbers at the end of the day. But the fact is, producer prices feed into consumer prices. If businesses are getting squeezed at the factory gate, they will pass on those costs to consumers in order to maintain their profit margins. And so the fact that we're seeing factory gate prices come back in is ultimately a good sign for the inflation pipeline in the United States. Yesterday's report was good, not great. The super core reading, which is X food, energy, and shelter, that actually ticked higher in the month of November. It's one of the reasons why I think the Fed is going to be a little bit more cautious about declaring victory just yet. And the base effects in the data, Angeline, actually cater to the December report, giving us a boost anyway. You could see a 0.0% month-over-month reading for headline CPI in the US, and it would lead to a 3.3% year-over-year reading, regardless of what happens. And so it just doesn't seem right for the Fed to declare victory today when you're staring down the pipeline at a potential short-term boost in inflation. It could get egg on their face, and ultimately they could start losing credibility once more in the market, which would be upsetting to everyone. So today, Fed is not going to declare victory. We're getting close to it, just not yet.
Just not yet. And the expirations that are incoming, that normally has some sort of impact on volatility, but it's getting pretty quiet as we count down towards Christmas. Are we going to see a few more ruptions than normal?
Well, you point out there's $5 trillion of options expiring this Friday. About 80% of those are linked to the S&P 500. Going into this options expiry, it's worth pointing out that we've seen, I think, 19 days in a row now where the S&P 500 hasn't moved in excess of 1%. And this is because of the structural nature of the flows we're seeing through options dealers in this market. Option dealers are net long gamma, which effectively means that when markets are rallying, they're selling stock futures. And when markets are falling, they're buying stock futures. This is putting a dampener on volatility right now. Everything is being pushed in the other direction. So stocks go up, dealers come in and they try to push down the price. That's helping keep things constrained. Maybe that means on the other side of this Friday, we could see a little bit more price action on the market unfold where we're not so tethered to these tight ranges. But it also means we're in the second half of the month of December, which brings about two observations. First off, volatility tends to be a little bit lower. Liquidity tends to be a little bit thinner. Trading volumes tend to go down. But when you look at seasonal studies, the second half of December tends to be better than the first half of the month. So if markets are unrestrained, people are feeling good on the other side of this Fed meeting, there's really nothing standing in the way anymore of the market continuing to scratch and claw its way to the upside, closing out the year near or at already those all-time highs.
Thanks very much, Chris Vecchio there from New York, from Tasty Live, part of IG Group for us. Now let's just take a quick look at some really key all-session stocks, starting off with Tesla, because we've got this Bloomberg report saying that Elon Musk's SpaceX will sell insider shares at $97 a piece in a tender offer. Now the key thing about this is that a price rise like this will boost the value of the space and satellite company closer to $180 billion. The other reason why I'm showing you Tesla's shares is because just checking in on that, it's down 0.2% all sessions. Tesla has recalled more than 2 million vehicles in the US, saying that the autopilot software system controls may not be sufficient to prevent driver misuse. Now, for those of you following the story, this comes at a time when the US regulator has been investigating autopilot since August 2021. I believe I'm right in saying that there have been more than a dozen incidents that are being investigated. And since 2016, the NHTSA has opened more than 3 dozen Tesla special crash investigations, where driver systems such as autopilot were suspected of being used. 23 crash deaths have been reported to date. Now, Tesla, the world's most valuable automaker, its shares down 0.2% on all sessions on the IG platform. We'll keep a close eye on those shares for you. Another one that is all sessions and staying in the auto sector is General Motors. Just checking in on this chart for you because General Motors CEO Mary Barra is due to speak at the Economic Club in Washington. She's likely to focus on the self-driving unit Cruise and about the company's costs and labor. Cruise as well has been in the headlines over incidents involving its self-driving capabilities. Now, one really big stock that we are keeping an eye on is Pfizer. Now, Pfizer's shares have been moving quite rapidly all sessions, just getting the share price up for you. Look at that red bar there. It is down currently more than 6%, actually almost 7% right now. And the reason for this is because the company's forecasts have come in below expectations. Now, don't forget, this company has been hit by a double whammy. Pfizer, like many of the other drug makers, has seen a drop in annual COVID vaccination rates. And also at the same time, a lot of its products like Paxlovid and the vaccine that it makes with German partner BioNTech have seen a drag in sales as the pandemic washes out of the system. Now, many of the analysts watching Pfizer hoping that Pfizer would come out with something new in the pipeline or some new product that might mean that it has further cash flow. Don't forget, Pfizer has announced cost cuts, jobs and expenses, both affected, now expected to save at least $4 billion a year for Pfizer. But its forecast still disappointed. This is for 2024, and its shares falling almost 7%. On the IG platform. Now, the CAC 40 has been quite interesting out of Europe in terms of a technical play. We've been looking at the NASDAQ, we've been looking at the Dow Jones Industrials, but Chris Beecham has been taking a closer look at the French index for us.
While the focus is on the Fed this afternoon and US markets ahead of that decision, it is worth noting that European markets, particularly on the continent, have done very, very well. And the CAC in particular has returned to its record highs from the end of April. Long slog for European markets. It's really been a tough 6 months or so for that index in particular, with some concerns about luxury stocks really driving it lower. But the rebound has been swift and impressive and does set the index up for a strong performance into next year as well. But it's certainly something to keep an eye on, of course, ahead of the ECB decision tomorrow.
And a quick check on commodities for you. US crude currently up almost 0.8%. However, it has to be said that oil prices have been weighed by supply concerns and also Yep Junrong, our IG market strategist on the oil side of things, has said that markets have priced in aggressive rate cuts for 2024. Any disappointment on that front could strengthen the US dollar and weigh on the risk environment, pushing down oil prices. Now, before we go, a quick look at how the market is looking for you. Just putting up the Wall Street for you, which mirrors the Dow Jones Industrials as we count down to the open. We are seeing a slight extension of gains there, but let me just show you the minute chart because this will give you a better indication of what happened after that PPI number. It went up slightly, came back down, and it's now ticking back up again. So quite a mixed reaction there. That's it for this edition of Beat the Street. For more analysis, do tune in to @Angeline Ong or @IGCom on Twitter. This is IGTV.